Welcome to the Big Ideas series. Today we have with us Professor Dan Awrey, who is a professor of law at Cornell University and an expert in financial regulation. He's going to speak to us about his book, Beyond Banks: Technology, Regulation, and the Future of Money. Thank you very much for joining us today.
It's my pleasure. Thank you.
Can you tell us a little bit about your book, why you wrote it, why it is relevant today?
Sure. So the premise of the book is that banks were not the end of monetary history, and that all over the world there have been a ton of experiments about new ways of delivering money and payments. Now, that makes sense. Technology changes, business models evolve, customer preferences change. But it creates a couple of problems. One set of problems is that once we remove money and payments from banks and from the comfort of the financial safety net that they enjoy, we have to ask questions about how money behaves in the shadow of bankruptcy, and ultimately then what it means to have multiple different types of legal monies in the world, and how that can contribute to things like consumer protection problems and financial instability. The other set of problems we have to deal with is that technologically speaking, banks and non-banks may offer very different types of payments. That is to say that your bank may not be as convenient as these other forms of money. And if that's the case, which I think it is, and as the book chronicles, what we should start to see is a growing divergence between banks, which have good money but bad payments, and non-banks, which have great payments, but because they're subject to bankruptcy, are a bad type of money. Yeah. And so the book is about understanding that problem and then laying out a blueprint for regulatory reform.
In your book, and right now you just mentioned, you explain the difference between good money and good payments. Can you tell us a little bit more about that difference, and why is that difference so relevant?
Sure. We often talk about money and payments as sort of being intertwined, right? And the reason should be obvious is that banks provide both, in effect. But ultimately, what makes good money and good payments are entirely different, and the policies that we need to ensure both are consequently quite different as well. Good money is all about whether we can be confident that a dollar is a dollar, a rupee is a rupee, a yen is a yen, a pound is a pound, always and everywhere. And then with that confidence, whether we actually use those pounds, rupees, and dollars as a medium of exchange. How many people want to actually use these instruments in the economy? That is a different set of issues than payments. When we talk about payments, we're talking about, well, how convenient is it to make a payment? How fast, how secure, how inexpensive? And ultimately, those are very different things. And the way that the law and institutions can actually promote those things is also quite different, and therefore deserves to be unbundled. They're both related, but we need to understand both separately so that we can deliver both for society.
In what ways do non-banks lose out to banks when offering payment services?
Sure. And it depends on from country to country, and lots of countries in the world are starting to experiment with different models. But the basic problem in many countries is that their payment systems are bank-centered. The central bank gives access to its balance sheet to banks and then builds out the payment infrastructure from those balance sheets. What that means is that non-banks are often left looking in, so they have to process payments through banks. So to provide products to their customers, they have to rely on their most important competitors. And that has all sorts of competitive implications and distortions for the marketplace. It also has potential financial stability implications. So to give one example, when Silicon Valley Bank failed in the United States in March 2023, its largest creditor, unsecured creditor, uninsured creditor, was the stablecoin issuer Circle, which had put about $3 billion into, or deposited $3 billion with SVB. And had the government not bailed them out, SVB out, would have reverberated to the customers of Circle. So SVB, as a result of the current structure and its bailout, also constituted a bailout of crypto in a very real way. And only because at the moment, every non-bank payment platform in many countries, including the United States and to a large extent India, have to go through banks.
What are your policy recommendations to level the playing field between banks and non-banks offering payment services?
Sure. So again, we have the split between money and payments. On the money side, I think what's necessary, and many firms have already started to experiment with this, or many countries have already started to experiment with this, is a payment charter that is separate from a bank charter. And that payment charter shouldn't allow the type of financial intermediation that banks can engage in, which means that it should be subject to a narrower, more tailored set of regulations and be subject to a non-bankruptcy resolution framework that is designed to make sure that if these firms fail, customers, to the fullest extent possible, get their money back. Reflecting, in effect, that these are technology firms, they are not banks.
Not banks.
On the payment side, it's then leveling the playing field through things like open access interoperability requirements to make sure that these non-banks have direct access to central bank reserve accounts and payment rails. And then making sure that the way that the governance of payment systems operates gives non-bank stakeholders a seat at the table. In effect, to make sure that no single set of stakeholders is making long-term decisions about which technologies to adopt and on what pace. It's not a perfect set of solutions, but in a world where, again, business models and technology are constantly changing, it can help smooth some of the rough edges around coordination of the development and adoption of new technology in a way that I think will ultimately benefit both consumers, but also the stability of the financial system.
Thank you very much for sharing these ideas with us. It has given us a lot to think about, especially in the Indian context where convenient payments are almost free for us. The government subsidizes it, and the long-term effects of, and we as consumers, we as policymakers need to consider the long-term effects of strategies such as this, and the fact that our transactions are routed through banks, even though they're not through bank tech systems. You have Google Pay, you have Paytm, you have a bunch of these UPI apps, but it's all routed through banks. So you've given us a lot to think about based on your experience in America about how we do payments in India.
Well, in a very real way, the world is watching India. It's watching its successes with UPI and in payments, and it'll be watching to see how it unfolds. It's still a work in progress. And as a leading experiment, the rest of the world will be seeing what works and what doesn't, and seeing how the lessons from India can apply to their own jurisdiction.
Thank you very much for your time today, Dan.
Thank you.